Hey everyone, I'm Cary Smith and I'm sitting here with Cheri Turner. Cheri is one of the financial advisors at Client First Capital. We're both with Client First Capital. And today we're talking about the amount of risk that someone would have in their retirement portfolio. And so, risk is something that, we hear a lot from our clients. It's something we talk about a lot. It's something we think about a lot. It's something that's important to get right. And so we thought that we would go a little bit deeper on that subject today. So Cheri, I'm going to have you kick us off and just
Okay.
kind of share with us, some of the things you think about or some of the things you talk to clients about as it pertains to retirement portfolio risk.
Yeah, absolutely. I would say one of the first and foremost factors to consider is your time horizon.
Okay.
Where are you within your retirement years? That determines, how many years that investment needs to provide for you, but also the amount of years that your portfolio has to recover in the event of some sort of downturn.
Yeah, it's interesting. We talked to a client recently who said, well, I'm very aggressive with this money because I don't need it for a long time, like 3 years. Right.
Right.
And so, I think it's worth it to say, well, let's define what kind of a short, a medium, or a long-term time horizon is, because 3 years is actually very short.
Right.
And without having some insights on this, investors can look at that different ways. But we really define anything less than 5 years as a short time horizon.
Mm-hmm.
I would say 5 to 10 years is a medium
Mm-hmm.
time horizon, and then 10 years or longer is a long time horizon,
Yeah.
right? And
Right.
so, but it's important that one, we identify when people are going to need those assets, and
Mm-hmm.
and to help us determine the right level of risk to have within a portfolio. So,
Right.
okay.
Right.
Um, I would say another thing that we talk about is managing market volatility.
Mm-hmm.
And so, volatility and risk are two different things.
Right.
And the market's going to have some volatility, and there's times that there can be a lot of volatility in the market
Right.
without there being a super amount of risk.
Mm-hmm.
And but a person does need to feel comfortable with the fact that things are going to move up and down, right, as they watch their portfolio. But market volatility is one of the things that we'll talk to clients about,
Right.
right? And so if your time horizon is, let's just say it's medium, and you're 7 to 8 years, and you're
Mm-hmm.
seeing volatility in year 1, 2, 3, or 4, right? It's probably something that we shouldn't overreact on.
Right.
However, if a person's not comfortable, absolutely, we should listen to them, and make sure that we have the risk set right for the amount that they're comfortable with. But
Yeah.
volatility and risk can be two different things.
Right. Right. Yeah. And to your point, I think there's something to be said for the self-awareness of somebody being cognizant of their own level of risk tolerance, right? That
Yeah.
do you experience anxiety over small changes within your portfolio? And if that's the case for you, then taking on too much risk is really a poor decision, because at that point in your life you should be enjoying life, not stressing yourself out. So
At this point in our careers, we've talked to a lot of people, and some people, just the thought of the possibility of losing some value in their portfolio just drives them crazy and keeps them up at night. While
yeah.
others, they don't worry about that in the least bit, right? And so,
Right.
so the risk conversation is very individualized. It's very
Mm-hmm.
personalized. If
Mm-hmm.
if you think you're comfortable with the amount of risk, and then you find yourself thinking about it constantly, or keeping you up at night, maybe it needs to be reevaluated. But it
Right.
is very personal. There's some industry guidelines and some ways that we can help a person judge the amount of risk that they should take.
Mm-hmm.
But at the same time, ultimately, their emotional comfort with that risk is very important.
Right, right. I think alongside risk tolerance is also risk capacity.
Okay.
How much capacity do you have within your portfolio to allow for that recovery? If you need those funds in that short term, then you need to be pulling potentially at a time where the market is down. Whereas if you have greater capacity, that means that you can wait it out without needing to access those funds during the downturn, and then pull at a better point in time.
Yeah, very true.
Um,
What are your thoughts on aligning with your retirement goals? And so, what I mean by that is, let's just say that you do have big plans on in your retirement, and you do have goals and things that you want to accomplish, and it's going to take some capital to get there. And you also need to make sure that this money is lasting your lifetime,
right,
right? And so,
right.
just kind of your thoughts on ensuring that your risk levels are also aligned with your retirement goals and maybe
Mhm.
the growth that you need to see within your portfolio to achieve those goals.
Right. Yes, absolutely. In that case where you have, a little bit more aggressive goals, then you would want to be a little more aggressive in your portfolio to allow for that growth to enable you to have those experiences. Again, assuming that you have that capacity within your portfolio. But if you are working towards something that you don't quite have the funds for, then you want to really balance that principal protection along with growth.
Okay. Okay. And I've got one more. Maybe you've got more, but I've got one more that I think we need to
Okay.
talk about. And when we meet with clients who are transitioning into retirement or living in retirement, they want to make sure that their portfolio is protected, right? So
Mhm.
that it's not eroded by inflation and other things. They
Right.
also want it to grow, right? They want it to
Mhm.
continue to compound. And so they want this really nice balance
Yes.
of of not putting their portfolio at risk, but also having enough risk that it grows. And so, but one of the things that we hear a lot from clients is we want to make sure that we're outpacing inflation. And
Yes.
so inflation has come up a lot lately, but it's an
Mhm.
important conversation when it comes to our retirement portfolios. And so just kind of your thoughts on protection, but
Mhm.
also with enough risk to make sure that we're still compounding and growing and outpacing inflation.
Right. Yes, absolutely. Taking a look at kind of your overall portfolio and determining, what proportion of that would you like to see in what we call your defined outcome component, which can be bonds and other types of more secure defined outcome investments. And then you balance that with a proper proportion for you of those, actively invested funds that are there for your growth opportunity. And so by balancing those, you're able to kind of achieve both objectives.
Okay. So I know we both knew this topic coming in, but we developed our talking points separately,
Uh-huh.
and so those were the key ones I had. Do you have anything else that you wanted to bring to this
There
discussion?
was one other thing that I had come up with, which is any other sources of income that you have throughout retirement. Your portfolio is only one source of income in your life. And so most people have Social Security, many people have pensions, and then some people have rental income. So,
Mm,
really kind of looking at and getting the full picture of what are the varieties of sources of income. And so, how significantly are you having to rely on your portfolio in order to meet your needs. So that was one of the other factors that kind of struck me.
what you just said, I think is so good, and I'm not surprised that you would have more topics than I have.
Mhm.
But what you said is so good because your retirement portfolio is not just your investment portfolio.
Right.
It's Social Security and it's pensions
Mhm.
and it's investment properties or rental properties or other things that you have that are all contributing to your retirement picture. And
Yes.
and I think that's it's good that you make that point because at Client First Capital, typically we are when we're working with the client, we're gathering all of those things and looking at them together, right,
Mhm.
to help us determine the best outcomes for our clients.
Yeah.
Okay. Hey, this was a good discussion. And,
Yeah.
I want to thank everyone for watching.
Thank you.
If you found this video helpful, please give it a like. It helps other potential clients discover it as well. Also, for more informative videos, you can visit us at Client First Capital Learning, where we have a complete library of videos. You can also check us out on our website at Client First Capital, where you can sign up for our newsletter as well. And with that, Cheri, I think that's it.
Yeah. Thank you, Cary. It's been enjoyable.
All right. Thanks, Cheri. See ya.
Bye.
Bye.